Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan live from Yahoo Finance's studios in London. It's Wednesday, 22nd October. Coming up on the show, AI giant Anthropic is in talks with Google over a multi-billion-dollar cloud deal. Earnings season rumbles on with the first of the Mag 7 Tesla reporting today. And despite tariffs, China's exports to the US grew in September. Okay, let's kick off with a quick look at where US stock futures stand. And Wall Street looks to open, well, pretty flat in the main, as you can see there. Meanwhile, gold and silver prices are going to be in focus today after suffering their steepest sell-offs in years yesterday. Okay, grab your coffee and let's own the morning. Well, let's kick off the things you need to know before the opening bell. Number one, the earnings parade continues and there are two blockbuster stocks in the spotlight. Netflix stock is down dramatically in pre-market, around 7% in the red as investors digest a disappointing earnings report last night. Netflix missed analyst expectations on both revenue and profit, with earnings per share at $5.87, lower than the company's own forecast of $6.87. Tesla, on the other hand, is reporting today after the bell. While sales in Q3 have been boosted by the end of a generous tax credit, the company is facing growing questions around its revenue forecast and the performance of Robotaxis, Optimus and artificial intelligence businesses. Other names reporting today after the closing bell include IBM, SAP and Alcoa. Number two, oil prices rose more than 1.5% with Brent above $62 and crude above $58. And this comes amid reports that the United States is close to reaching a deal with India. As part of the agreement, Delhi would wind down its imports of Russian oil. In exchange, Washington could slash tariffs on Indian exports to around 15% from the current 50%. For our third thing to know, we stay on global trade, and this one is bad news for President Trump. Well, despite the tariffs and ongoing negotiations, China's exports to the US are up in September from the previous month, hitting about $1 billion a day. It's a reminder of Beijing's bargaining power as America continues to buy its goods. Negotiations continue between the world's largest economies, even though the president said that his highly anticipated meeting with Xi Jinping could be off. Well, it might not happen, and that's adding a bit of a chill to Asian markets this morning. Now, one company everyone's watching today is definitely Apple. Can it hit that magic $4 trillion market cap today? Shares aren't moving too much in pre-market, but my colleagues here on Yahoo Finance discussed with Tom Essay from 7 Reports why he and other traders are so bullish on the stock.
Looking at Apple versus NVIDIA, I think that I prefer Apple. I think that we have seen a lot of expectations baked in around the AI supercycle, and that's worked wonderfully, right? NVIDIA shareholders have done fantastically well. But I think that Apple was really viewed as the laggard in this race, and they got discounted because of it. Their core business is still doing very well, though, and I think that people are appreciating that now. So I like Apple on a continued catch-up here as opposed to chasing NVIDIA, with all the momentum that it has.
Inez, get in here. It looks like you want to stay bullish on NVIDIA. Not that you're picking stocks, but I can see it. Or maybe I'm wrong.
No, I mean, look, NVIDIA is great, and it has been a massively great play, and people are long NVIDIA. As far as Apple, I do agree with Tom in the sense that their core business is still strong. I mean, the demand for 17 iPhone upgrade, that is supposed to go into 2027. Wall Street's very bullish on that. And I'll also say that the connected home devices as well, that they're going to be making also in Vietnam, I believe, that is also going to be playing part of the entire ecosystem for Apple. I think that Wall Street is very bullish on that.
Well, it's time now for today's trending tickers. We start with Google. Anthropic is in talks with Google about a deal that would provide the AI firm with additional computing power valued in the high tens of billions of dollars. Shares of Google parent Alphabet are higher in the pre-market. Now, the plan, which has not been finalized, involves Google providing cloud computing services to Anthropic. But in a possible threat to Google, OpenAI yesterday announced ChatGPT Atlas, a new artificial intelligence-powered web browser. Remember that Amazon, one of Google's main rivals in the cloud space, is one of Anthropic's biggest investors. Also in the consumer space, Samsung Electronics released its Galaxy XR extended reality headset yesterday. The South Korean tech giant is counting on AI features from Google to propel it into the nascent and uncertain market of computing on your face that is dominated by Meta and Apple. Okay, a stock that's featured heavily this week on trending tickers and for good reason. Beyond Meat. The stock has certainly gone viral. Yesterday, it closed 600% higher over the past 3 trading sessions. It's having a meme stock moment, despite fundamentals of the plant-based burger maker being anything but sizzling. Yesterday, we heard that its Beyond Burger 6-pack will be available in 2,000 Walmart stores, and on Monday, the stock was added to the Roundhill Meme ETF. Okay, moving on to a financial stock that's popping in the pre-market, Capital One. It reported impressive results overnight with a 23% rise in revenue. The interesting thing here, though, is that it announced a new $16 billion share repurchase authorization and plans to increase its quarterly common stock dividend from 60 cents to 80 cents per share. Okay, let's check in on Netflix. As we heard, results missed the mark and shares are down heavily in the pre-market. And remember, Tesla reports later. Shares are slightly higher in the pre-market for now. But here's Stephen Gengaro from... Oh, they're slightly down in the red now. Here's Stephen Gengaro from Stifel Next Gen with what to watch out for when the EV maker reports.
The third quarter, I think, clearly benefited from some pull forward of demand from the EV tax credits going away on September 30th. So that clearly helped sales, and we saw it in the Tesla numbers, and we'll get more color here tomorrow night. I think as we go forward here, in the U.S. market, we would not be surprised to see a bit of a downtick here over the next couple quarters. Part of that, I think, is related to the pull forward of demand that I mentioned. I think part of it is related to the fact that the cars are just going to be a bit more expensive near term without the EV tax credits. If you looked at some of the deals out there, not only from Tesla, but other EV manufacturers in the U.S., there were some pretty compelling buying opportunities into the end of September. And I do think that leads to a couple quarters here where you get some softness in EV sales.
What about, Steve, those new lower priced Model 3 and Y models? What do you see that meaning what does that mean for growth and for margins looking ahead?
Yeah, I think, and you bring up a good point, Josh, on the margin side, right? As we look into the fourth quarter and the first quarter, the lack of credits and Tesla pushing lower priced vehicles to maybe offset things on the volume front, probably do create a margin headwind in the near term. I think when you look at Tesla's business model over time, I think Elon wants as many Teslas in the market as he can, not only people buying the cars, because it sort of underpins the potential growth in the full self-driving side, and then ultimately the Robotaxi business over time. So I think there's probably some margin headwinds in the next couple of quarters. I do think those lower priced cars help sort of lessen the blow, on volumes over time. But I think in the short term, it will have an impact on volumes.
Okay, time for a short break. But when we're back, our tech editor, Dan Howley, takes a closer look at what to expect from OpenAI's new web browser. Welcome back to Market Sunrise. We've got some big news now coming from the tech space. OpenAI has announced its new browser or internal search engine named Atlas. It's a direct rival to Google's Chrome software and others. Dan Howley has more.
Yeah, big browser showdown. This is the ChatGPT Atlas, and it is OpenAI's own web browser. And yeah, this is going right up against Google's Chrome. Chrome has around 72% of global market share when it comes to the web browser. I'm sure most people use it on the regular, unless they're using Safari on their iPhone. But even outside of that, people still download it. So this is OpenAI's stab at taking on that part of Google's market share in the browsing space. They also obviously have ChatGPT, which goes up against Google's own search. And so the big differentiator here is that ChatGPT is built directly into Atlas. You'll be able to do things like use natural voice search for old tabs that you may have closed, or Google Docs that you've worked on in the browser, as well as just type your standard URLs for things like yahoofinance.com, all in the same box. You can also have something called an agent. So what this will allow you to do is have the web browser essentially do things like shop for everything that you need on your weekly grocery list via Instacart, or book reservations for a restaurant. So it's one of these kind of new brands of browsers where they're putting all of the generative AI know-how into it, so that you don't have to necessarily, go in Chrome and then navigate to ChatGPT's website itself. You can just do it all from there. Google, they also have their own Gemini capabilities in the Chrome browser, and the Google search, that's the AI mode or AI overviews. Perplexity has its own browser. Microsoft's Edge has built-in Copilot. So we're seeing more and more of this AI trickle in. But I do think that OpenAI itself poses this kind of almost existential threat to Google, not immediately, right? But there is that creeping fear.
Well, that's what I wanted to ask you. I wanted to ask you, like out there in Mountain View, California, Alphabet headquarters, I want you to, how worried do you think they are? How worried should they be?
I think, initially they were freaking out, right? Because once, when ChatGPT came out, they were kind of, just caught flat-footed like the rest of the industry, except for Microsoft. And since then, they've managed to catch up more and more with Gemini. There's almost like a kind of back and forth between all of the AI models, which is better, which is top of the heap. They all kind of trade positions all the time as new versions come out. So Google is okay there, but I think it's really that mind share, right? When you think of AI, you think of ChatGPT, you think of NVIDIA, right? Google, you think of search. And yes, they are making AI a big portion of search, right? They'll say that, however many millions of people use AI overviews. That's just there when you use a regular Google search. It's not like you're navigating to that on purpose. You have to be purposeful to use something like ChatGPT. So I think that that's probably where they're caught up. Is that Chrome is still the leading browser. People still use Google for standard search for the most part. But when you think about AI and you think about where these things going, it's ChatGPT.
Okay, time for another break, but we'll be back with market movers and a closer look at French luxury stocks. Should you buy them or not? Stay tuned to Yahoo Finance. Okay, for market movers, we're focusing once again on earnings. We start with Hilton. Now, the worldwide hotel chain has lowered its full-year outlook as demand for US rooms fell. It's been a bumpy time for US hotel companies as a pullback in foreign visitors and government travel have collided with weaker vacation demand. Now, the key metric, revenue per available room, actually fell 1.1% in Q3, but shares are higher in the pre-market. Revenue came in a little bit stronger than expected. Okay, next up, Boston Scientific. Now, Boston Scientific boosted its adjusted earnings per share guidance for the full year. The guidance beat the average analyst estimate. Remember that Boston Scientific has already agreed to buy Nalu Medical, a private developer of neurostimulation systems for chronic pain, in a deal valued at around $533 million for the equity it doesn't already own in the company. Okay, next up, AT&T. Now, it reported strong third quarter results that demonstrate continued customer demand for its wireless and fiber offerings and position the company to deliver on its full-year consolidated financial outlook. Now, adjusted earnings per share of 54 cents for the third quarter, that actually matched the average analyst estimate, and shares are just a smidge higher in the pre-market. Okay, next up, the energy arm of GE Vernova. It has reported mixed Q3 results, sending shares initially lower in the pre-market. Let's have a look at where they are now. Revenue of $9.97 billion did beat the street call, and that's helped push the share price higher now. But earnings per share missed just $1.64. That was more than 20 cents off the expectations. And Tech Resources, the Canadian miner, the Anglo-American has agreed to buy, said that its Q3 earnings jumped 19%. Now, rising metal prices helped offset disruptions at its main copper mine in Chile. Third quarter net profit came in at just above $200 million. That's up from a near $500 million loss last year. Okay, well, let's stick with earnings, and the big one last night was Netflix. Here's Geeta Ranganathan from Bloomberg Intelligence.
I think investors were really looking for management to actually increase their operating margin guidance from 30% for the full year 2025 to a little bit more, maybe 31, 32%. They've actually now taken that down. And it looks like a lot of that can be attributed to the 3Q operating margin miss. So definitely somewhat underwhelming, just because we know that both third quarter and fourth quarter is supposed to be one of their best content slates ever. We've seen some very, very strong and encouraging metrics when it comes to engagement. You had the breakout hit with K-pop Demon Hunters, so all of that was kind of really feeding into, I think, this investor frenzy for better results. But, obviously the tax dispute was something that nobody could have foreseen.
They are, it sounds like, touting, Geeta, what they're calling record subscriber engagement. What are the trends and themes there? What are your questions around that metric?
Yeah, so that's exactly what they've been telling us all through. So the first half, and they already reported metrics in terms of, overall viewing hours, overall engagement, that was somewhat muted, I would say, from the first half of this year when you compare it to last year. But then you look at, if we've just run some internal numbers as well, you look at the third quarter engagement metrics, really, really strong. And that's exactly what they're referring to in their investor newsletter. We've seen something like a 20 to 22% surge in engagement. And a lot of that just from all of those big monster titles. I mean, you have 3 of their most watched ever series just debuting in the third quarter. You have, K-pop Demon Hunters, which we just spoke about, biggest movie of all time, which came up in the third quarter. And then, of course, you had Squid Game season 3, as well as Wednesday season 2. Again, some of their most watched series ever. So all of that really driving very, very good engagement. And remember, engagement is the way that we are going to kind of evaluate this company going forward, because content drives engagement, drives monetization. And that's really where Netflix's pricing power kind of is anchored.
Geeta, I feel like I got to ask you, I'm sure you saw the report today suggest that maybe Netflix is one of those parties that could be interested in Warner Brothers Discovery, Geeta, or at least parts of Warner Brothers Discovery. What do you make of that? If you saw that Netflix really made a move there, would that be the smart move strategically?
Strategically, yes, it does make sense. I mean, they do have some very, very compelling, IP that would, help them with subscriber trends, that would help them lower churn, increase engagement. We just spoke about engagement. So all of that, yes, it makes sense. But traditionally and historically, when you've kind of seen Netflix's strategy over these past so many years, they've spent about $1 or $1.5 billion totally on M&A. So really, they've been very, very shy. There just hasn't been that appetite, and investors have kind of liked that build versus buy strategy. So I don't think anybody was really expecting Netflix to kind of come out swinging. Having said that, though, this is a once in a generational opportunity. Warner Brothers is a great studio. There's a great studio lot there, and there could be a whole lot of synergies that Netflix can achieve with the combination. So again, it's a little.
Okay, is French luxury a buy or a sell? Well, many investors today seem to be leaning towards the latter. Look at these iconic French stocks, and they are also some of Europe's largest companies as well. Hermès and L'Oreal, they're down sharply after their respective earnings reports. LVMH is little changed in Paris trading, but investors are watching closely as there are rumours of a potential sale by LVMH of Fenty Beauty, which co-owned with star singer Rihanna. Let's break it down. L'Oreal, which is more of a consumer brands conglomerate than a luxury company, had some positive sales results in China. But the CEO said, quote, "One quarter doesn't make a trend." Investors clearly didn't like that one and decided to sell off. That's also Deutsche Bank's call. The bank kept the target price of €340 per share unchanged, but reiterated its sell rating. Analysts from RBC agree, and they said the magnitude of improvement from L'Oreal is underwhelming. It's a very different story for Hermes, which has been weathering the geopolitical tensions pretty well so far this year. And to be fair, revenue grew 9.6% year on year. But some analysts point out that investor expectations may have been very high, maybe too high, in the wake of Louis Vuitton's positive results a few days ago. Still, even if the stock is going down this morning, Deutsche Bank, Citi and others see the results as a potential turning point for luxury and rate Hermes a buy, and that's despite ongoing geopolitical tensions and a political crisis in the country. Okay, another stock that's been trending since we covered its results yesterday is General Motors. It's been rising on strong results. Yahoo Finance executive editor Brian Sozzi spoke with GM CFO yesterday about the automaker's strategy shift.
Well, really what we're doing, Brian, is kind of shifting some of the undercapacity that we had in the U.S., filling that up and shifting that to other plants globally. But, Orion is a great example of that. This is a plant that we were bringing up for a lot of EV demand. That's clearly not going to happen over the next several years. So instead of continuing down the path of making a lot of EVs that the customers maybe aren't ready for at that level of demand, we've shifted that into internal combustion engine production. Gives us a little more incremental production on full-size SUVs, but allows us to domestically produce a lot of full-size trucks that are going to help to ease that tariff burden going forward. So that'll come online at the end of next year in early 27, and we're very excited about that. And I think it'll be a big win for our customers.
In this regard, are the president's plans working?
I think they are for us. I mean, he's always supported the U.S. auto industry, and I think this is a really important industry for the country as a whole. And as we look at that tariff burden, making sure that we raise the concerns about ensuring that we're competitive with all the importers that are in the market, things like the MSRP offset expansion have really helped us in a way. I mean, ideally, would we rather not have tariffs? Probably. I mean, our margins would be about 300 basis points higher, but this isn't something we're making excuses for. We're just going in and trying to perform, and we think we can be on that path to get back to 8 to 10% margins.
With our market check, we start with gold. Now remember, the yellow metal fell 6.3%, recording its biggest intraday decline in over 12 years yesterday. Silver also dipped more than 2% and do you know what? In pretty choppy trade today so far, it's falling once again, heading downwards, this time towards the $4,000 mark. Let's turn to Asian markets now. And it's fair to say it's a bit of a mixed bag today. The Nikkei's record-breaking run, has come to an end, only down slightly though, after export data missed expectations there. Meanwhile, South Korea, look at that. The Kospi set a new record closing record, marking its 6th straight winning session. Let's move on to European stocks. Now, apart from the FTSE 100, the rest are down, and they're basically consumer products and services are leading the declines. Energy stocks, though, did rise as oil prices regained, and the reason the UK's up more than the rest is that UK inflation data came in better than expected, perhaps boosting sentiment there for rate cuts. Okay, that is all we've got time for today on Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.